Welcome where unda dumalang molo sawubona hukandat, and a warm welcome to the Indufu Knowledge Cast, the podcast, where your curiosity meets insightful conversations. Today, we're tackling a topic that might sound drier than the Kalahari in winter, IFRS 9, but trust me, it's way more exciting than it sounds. We've got excerpts from the actual IFRS 9 document definitions, explanations, the whole shebang. Luckily, we've got expert speaker here to help us decode it all. You ready to become a bright-eyed IFRS 9 guru?
Absolutely. IFRS 9 might seem intimidating, but it's really about making sense of the financial world. It's like figuring out how to build a BOMA. You need a solid framework to keep everything in order.
Okay, I'm intrigued. So what exactly is this IFRS 9 BOMA all about? Give us the lay of the land.
Essentially, IFRS 9 sets the rules for how companies classify and measure their financial assets and liabilities. It's the guidebook for how they track their rands and cents, from investments to loans and everything in between.
So it's like the recipe book for a company's financial podgy. But why should we care? How does this affect us everyday South Africans?
Well, think about it. Whether you're buying shares on the JSE, starting a business, or even just trying to understand your bank statement, knowing how companies report their financials is crucial. It's about knowing the ingredients before you take a bite of that financial Gatsby.
Right, because a Gatsby with dodgy ingredients is nobody's idea of a good time. So how do they go about categorizing all this financial stuff? I'm seeing terms like amortized cost and fair value. Feels like I need a dictionary just to get started.
Don't worry, you don't need to speak fluent accountant to understand this.
Yeah.
IFRS 9 has a few key categories,
Yeah.
and they're not as scary as they sound.
Okay, hit me with them.
First up, you've got amortized cost. Think of it like paying off your home loan. You make regular payments over time, and the value of the loan decreases steadily. It's predictable and straightforward.
Straightforward. I like it.
I like
What about fair value through profit or loss? That sounds a bit more unpredictable.
It is. Imagine buying and selling stocks on the JSE. The value can go up or down like a roller coaster. Companies using this category report changes in value directly in their profits and losses.
So if a company's investments take a dive, everyone knows about it. No hiding those losses under the rug.
Exactly. Now, there's also fair value through other comprehensive income. This one's a bit more nuanced. Imagine you're investing for the long haul, like retirement. The value might fluctuate, but those changes are reported separately. It doesn't directly impact the company's profits in the short term.
Okay, so different categories, different ways of reporting. Why does it matter which one a company chooses? What's the big deal?
It all boils down to how a company presents its financial health to investors and analysts. The choice of category can significantly impact their reported profits and overall financial picture. It's like choosing between biltong and Drewers. Both tasty, but they hit the spot in different ways.
I'm starting to see how this all fits together. But what happens when things go wrong? When those investments turn sour? I see this section on impairment, and it sounds a bit ominous.
Impairment, that's where the rubber hits the road. It's about recognizing when those good debts go bad. It's like realizing you lent money to that cousin who always forgets to pay you back.
Ouch, I know that feeling. So companies have to fess up when they've lost money? No sweeping it under the carpet?
Exactly. They need to recognize those losses, and they need to do it early. IFRS 9 is all about being transparent and realistic about potential risks.
Okay, transparency is key. But how do they actually figure out if a debt's gone bad? Do they just wait for someone to stop paying their borrower's bill?
It's a bit more complex than that. They assess something called credit risk, which is the likelihood of a borrower defaulting. They look at changes in the borrower's financial situation, industry trends, even the overall economy.
So it's like checking the weather forecast before heading out on a road trip. You want to be prepared for any potential storms.
Precisely. They need to be forward-looking, anticipating potential problems before they become full-blown disasters. Imagine investing in payphones right before cell phones took off. That's a credit risk you'd want to recognize early on.
Oof. Yeah, talk about a bad investment. Speaking of managing risk, I keep seeing this hedge accounting thing pop up. Sounds a bit like something out of a Harry Potter spellbook.
Think of it more like a raincoat protecting you from the unpredictable storms of the financial markets. Hedging is how companies manage risks, like fluctuations in interest rates or those wild swings in the rand. Remember when the rand was yo-yoing all over the place?
Don't remind me. I was planning a trip to Mauritius, and suddenly my budget went out the window.
Exactly. Hedging can help companies minimize those kinds of risks. Let's say a company is importing avocados from Kenya, and the rand weakens against the Kenyan shilling. Hedging can protect them from losing money on that transaction.
So hedging is like taking out insurance against financial risk. Makes sense. But how does this all tie back to IFRS 9?
IFRS 9 has specific rules for different types of hedges. For example, there are fair value hedges, which protect against changes in the value of an asset or liability. Then there are cash flow hedges, which protect against fluctuations in cash flows. Each type has its own accounting treatment, which can get a bit technical.
Sounds like we might need a whole other deep dive just to unravel the mysteries of hedging.
We might just, but understanding the basics is a great start.
Well, we've covered a lot of ground already. From categorizing financial instruments to tackling impairment, and even dipping our toes into the world of hedge accounting. It's fascinating to see how these seemingly technical rules actually play out in the real world, affecting businesses and investors alike. But let's bring it back home. What does all this mean for us here in Mangzansi? How does IFRS 9 affect South African businesses on the ground?
Welcome back to the Indubo Knowledge Cast, where we're unpacking all things IFRS 9 and its ripple effects on the South African economy.
My brain's still buzzing from our last chat about impairment and hedge accounting. Feels like I just finished a crash course in financial wizardry.
Well, get ready for round two, because we're about to zoom out and see how these accounting practices can shake things up on a much larger scale.
So we're talking about how one company's financial decisions can end up affecting the whole country, like a veld fire spreading across the landscape.
That's a great analogy. One area where IFRS 9 has a major impact is investment decisions. Remember how the standard requires companies to recognize expected credit losses sooner rather than later?
Yeah, that was the part about those overdue borrowers' debts coming back to bite you.
Right. By recognizing those losses, earlier companies might become more cautious about lending money, especially to businesses or individuals seen as riskier. This could make it harder for smaller businesses, startups, or even ordinary South Africans to get loans or access credit. Think higher interest rates or tougher lending criteria.
So it's like a double-edged sword. On one hand, IFRS 9 promotes good financial hygiene, preventing those nasty financial meltdowns. But on the other hand, it could make it harder for some folks to get the funding they need to grow their businesses or achieve their dreams.
Exactly. It's all about finding that sweet spot, that Goldilocks zone where we're being prudent but not stifling innovation and opportunity. And that's where regulators and policymakers come in. They need to carefully consider the potential consequences of IFRS 9 and create policies that support economic growth while also keeping the financial system stable.
It's like walking a tightrope, isn't it? Balancing those competing priorities. Now, what about attracting those big international investors? Does IFRS 9 play a role there?
Absolutely. Access to capital is another crucial aspect. IFRS 9 can actually make South African companies more appealing to foreign investors.
Ooh, this is where we talk about bringing in those big bucks from overseas.
Indeed. If IFRS 9 is seen as making our company's financial statements more transparent and comparable to international standards, it can boost investor confidence and attract more foreign direct investment, or FDI for short.
Okay, so clear and reliable financial reporting is like a welcome mat, signaling to investors that South Africa is open for business and ready to roll out the red carpet.
Think of it like a Shisanyama with a great reputation. Everyone wants a taste of the action.
Makes sense. But what if there are inconsistencies in how IFRS 9 is applied across different companies or industries? Wouldn't that make investors nervous? Like finding a pet fly in your bunny chow.
You hit the nail on the head. Consistent and high-quality implementation of IFRS 9 is absolutely crucial. It's not enough to just have the standard in place. We need to make sure it's being used effectively and uniformly across the board. This requires strong oversight from regulators, robust auditing practices, and ongoing training for those accounting whizzes.
So it's like building a taxi rank. You need clear markings, well-maintained vehicles, and drivers who know the rules of the road to keep things running smoothly.
A perfect analogy. Now, beyond investment and access to capital, IFRS 9 also plays a role in the overall stability of our financial system. Remember those hedge accounting raincoats we talked about?
Yeah, protecting companies from those financial downpours.
Well, by encouraging companies to use hedging more effectively, IFRS 9 can actually help build a more resilient financial system. Hedging helps to mitigate risks, reduce volatility, and make companies less vulnerable to those economic shocks.
So it's like reinforcing the foundations of our financial system, making it sturdier and more earthquake-proof, creating a system that can withstand those inevitable storms without crumbling.
Exactly. And this is particularly important in emerging markets like South Africa,
Yeah.
which can be more susceptible to those global economic tremors. We need a financial system that can weather those storms and keep things running smoothly.
Okay, I'm starting to see the bigger picture here. IFRS 9 is not just about numbers on a spreadsheet. It's about creating a more stable, transparent, and resilient financial system for South Africa. But before we wrap up, I have one more question that's been nagging at me.
Go ahead, share.
We've been talking about IFRS 9 as this set of rules, this financial Bible. But we all know that real people are behind those numbers. Where does human judgment come into play in all of this? Are we just robots crunching data?
That's a brilliant question, and it highlights a crucial point that often gets overlooked. While IFRS 9 provides that all-important framework, it can't cover every possible situation or anticipate every nuance of a complex financial deal. There will always be gray areas, moments where those judgment calls need to be made.
So it's not just about plugging numbers into a formula. It's about understanding the underlying principles, interpreting the spirit of the standard, and applying those concepts to real-world scenarios. And that requires experience, expertise, and a healthy dose of good old-fashioned common sense.
Precisely. Accountants and financial professionals aren't just number crunchers. They're interpreters, analysts, and decision makers. And their judgment plays a vital role in ensuring that IFRS 9 is applied fairly consistently and in a way that reflects the economic realities on the ground.
So it's like being a referee in a rugby match. You need to know the rules, but you also need to use your judgment to make those tough calls in the heat of the moment.
That's a great analogy. And this brings us to a crucial point. The effectiveness of IFRS 9 hinges not just on the standard itself, but on the people who apply it. We need skilled professionals who understand the ins and outs of the standard, who can exercise sound judgment, and who are committed to ethical and transparent financial reporting.
So it's about investing in human capital, nurturing a culture of professional excellence, and upholding those ethical standards. It's about recognizing that financial reporting is not just about numbers, but about trust, accountability, and building a solid foundation for our economic system.
Beautifully put. And that brings us to another critical aspect that we'll explore in the final part of our IFRS 9 saga, the evolving nature of the standard itself.
Ooh, sounds intriguing. Yeah. So IFRS 9 isn't just a static set of rules, it's a living, breathing entity that adapts and evolves over time, like a chameleon changing its colors.
Exactly. As the financial world changes, so too must the standards that govern it. In the next segment, we'll delve into those ongoing revisions, amendments, and interpretations that shape the ever-evolving landscape of IFRS 9. We'll explore the forces driving these changes, the challenges of implementation, and what it all means for South African businesses navigating this dynamic terrain.
I'm already on the edge of my seat. It sounds like we're about to uncover the secrets of IFRS 9's ongoing metamorphosis. But for now, dear listeners, we'll have to leave you with that cliffhanger. Until next time, stay curious and keep those brains ticking. Welcome back to the Induba Knowledge Cast, fellow adventurers in the world of finance. Today, we're reaching the summit of our IFRS 9 expedition.
Indeed. We've traversed the fundamentals, surveyed the economic panorama, and now we're poised to unravel the enigma of IFRS 9's continuous transformation.
My brain feels like it's just run the Comrades Marathon. But the view from up here is breathtaking. We've got a handle on the basics, we've seen how it all connects to the bigger picture, and now we're ready to tackle the shape-shifting nature of IFRS 9 itself.
As with any grand expedition, the terrain is in constant flux. What might have been a clear path yesterday could require some detours today. New trails emerge as we deepen our understanding of this intricate landscape.
Okay, I'm picturing IFRS 9 as this winding road through the Drakensberg. Lots of twists and turns along the way. What kind of forces are shaping these changes? Who's deciding what needs a tweak or a complete overhaul?
Well, it's not some mysterious figure lurking in the shadows making arbitrary changes. The evolution of IFRS 9 is driven by a chorus of voices. Feedback from stakeholders shifts in the global economic climate, and even those tech wizards shaking things up with their innovations.
So it's a collaborative effort, involving everyone from accountants and regulators to investors and those tech gurus in Silicon Valley.
Precisely. The IFRS Foundation, the folks responsible for developing and maintaining these standards, are constantly keeping tabs on how IFRS 9 is being applied in the real world. They gather feedback from companies, auditors, investors, everyone involved, to pinpoint areas that need clarification, improvement, or even a major revamp.
So it's like a massive feedback loop. They're listening to the people on the ground, getting input from those who are using the standard day in and day out, and then using that information to fine-tune and adjust. It's like a software update for the financial world.
That's a spot-on analogy. And just like those software updates, sometimes these revisions and amendments can be pretty significant. They might introduce brand new requirements, modify existing guidance, or even clear up any confusion or ambiguity that's cropped up.
Okay, so IFRS 9 is a bit like a chameleon, constantly adapting to its environment. But these adaptations can't happen overnight, right? I imagine there's a whole process involved in making these changes.
Absolutely. The process is rigorous and transparent. The IFRS Foundation typically releases what they call exposure drafts, which are basically proposals for changes to the standard. They then invite public comment on these drafts, giving everyone a chance to weigh in, offer suggestions, or raise any concerns. This ensures that the final amendments reflect the diverse needs and perspectives of the global financial community.
So it's like a public consultation, a bit like a Leckgadla, where everyone gets a chance to voice their opinions on the proposed changes. This ensures that IFRS 9 stays grounded in reality and doesn't become some ivory tower standard that's out of touch with what's happening on the ground.
That's exactly the aim. It's all about keeping the standard relevant, practical, and responsive to the ever-changing needs of the market.
Now let's talk about those implementation challenges. I imagine keeping up with all these changes can feel like trying to herd cats for South African businesses.
It certainly can be, especially for smaller companies with limited resources or those in sectors that are particularly sensitive to changes in IFRS 9.
So what can companies do to make this transition a bit smoother? Any tips for navigating these choppy waters?
First and foremost, staying informed is crucial. Companies need to be on top of the latest developments, track those exposure drafts, and participate in those public consultations. They need to understand how the changes will impact their specific business and make the necessary adjustments to their accounting systems and policies. Think of it like a game of chess. You need to anticipate your opponent's moves and plan your strategy accordingly.
Makes sense. It's about being proactive, not reactive, anticipating those changes and adapting your game plan. But keeping up with all that technical jargon can be a bit overwhelming.
That's where seeking expert advice can be a game changer. Bringing in seasoned auditors or consultants who specialize in IFRS 9 can help companies navigate those complexities and ensure they're on the right track. Think of it like having a seasoned tour guide when you're exploring uncharted territory. They can help you avoid those pitfalls and make the journey a lot smoother.
Okay, staying informed and tapping into that expert knowledge are key. What other steps can companies take to handle this constant evolution of IFRS 9?
Investing in training and development is essential. Companies need to ensure their accounting teams have the knowledge and skills to apply the standard correctly, especially as those revisions and amendments come into play. It's about equipping your team with the tools they need to thrive in this dynamic environment.
So it's not just about having a few financial gurus at the top who understand IFRS 9. It's about building a culture of financial literacy across the entire organization.
Precisely. It's about creating a whole team of IFRS 9 champions who can not only apply the standard, but also explain it to others, advocate for best practices, and even contribute to the ongoing development of the standard itself.
Well, expert speaker, you've given us a fascinating glimpse into this ever-changing world of IFRS 9. It's clear that this standard is more than just a static set of rules. It's a dynamic framework that demands constant attention adaptation and a dedication to excellence. But as we wrap up our deep dive, I'm curious about the road ahead. What does the future hold for IFRS 9?
That's a great question, and one that sparks endless possibilities. IFRS 9 is likely to continue evolving, adapting to new challenges, embracing technological advancements, and striving for ever greater transparency and comparability in financial reporting worldwide. One area where we might see significant leaps forward is in the realm of technology. Imagine a world where artificial intelligence and machine learning can handle those complex calculations, automate certain reporting tasks, and even provide real-time insights into a company's financial health.
Wow. That sounds like something straight out of a sci-fi movie. Accountants working side by side with robots.
It might not be as far-fetched as it sounds. Technology has the potential to revolutionize how we approach financial reporting, making it more efficient, accurate, and insightful.
So IFRS 9 is not just about the present. It's about shaping the future of finance. It's about embracing innovation, harnessing the power of technology, and continuing to raise the bar for transparency and accountability.
Precisely. And as we navigate this ever-evolving landscape, one thing remains constant. IFRS 9 will continue to play a crucial role in shaping the global financial system, fostering trust, and promoting sustainable economic growth.
Well, dear listeners, we've reached the end of our IFRS 9 adventure. We've explored the fundamentals, delved into the economic implications, and even peeked into the future of financial reporting. I hope you found this deep dive enlightening and engaging and maybe even a little bit entertaining. Until next time, stay curious, keep those brains ticking, and remember, knowledge is power.